So before we start today, I do want to say that what I'm about to talk about is not investment advice. This is simply reading a report that is put out by a wealth management fund, and that's all it is. This is not a strategy that you should base your investments on. I just want to make that very clear. Okay, so today we're going to read about investment insights from UBS. For those of you that don't know, I'll link below, but essentially it's a wealth management fund, and they are present in anywhere there's a financial center. This wealth management fund has presence in it, and as far as I understand, it's 520 banks or so that they represent. So these people are in the know, right? And interestingly, I wanted to talk about that because they have a very different take on the US market than I would have expected, to be quite honest, and what I have read. Now, albeit, most of the stuff you read online, depending on the social media, as we've seen, because there's been like a fragmentation in the opinion space, right? It'll be biased. So you have to be careful of which side you read. Money is not biased, right? Money goes where money's going to grow. Pretty straightforward. I don't think I'm saying anything controversial there. So these analysts that write these things up, right? They are interested only in generating wealth and a return for their stakeholders, right? And the stakeholders, obviously, for UBS, and it's just not me, you can actually check on their website, are obviously their shareholders, but as well as their employees and then the banks that they represent, right? So those are more or less the three stakeholders that they're talking about when they talk about making the maximum return for their stakeholders. Now, interestingly, they see the U.S. equities as attractive, and they delve into the explanation as to why. And at the time of the recording, it's only been 6 days after this insight has been published. And so there's three main reasons, right? So on April 2nd, President Trump had Liberation Day, quote unquote, which was basically an announcement of tariffs, which I don't think anybody was expecting them to be as harsh as they were. Definitely UBS apparently was not, and that followed by tit-for-tat escalation between China and the U.S., which are obviously the two biggest economies on the planet. And U.S. tariffs on imports from China are now totaling 145%, and I'll explain a little bit more below, but they also talk about there used to be parcels that were $800 or valued at $800 or less, apparently didn't have to pay very high duties, and now it's up to 90%, I think. So we'll see that in a little bit here. But that's the first reason. But on April 9th, so 7 days later, President Trump announced reciprocal tariffs pause to other countries. And so that seems to be the strategy from the current administration in the U.S., where they escalate with all countries to then look for negotiated settlements, right? So they think that that was done on purpose, obviously. But interestingly, again, even with all the downside and all the economic headwinds, the UBS analysts expect there to be a growth in the U.S. economy this year, with the S&P, was a Standard & Poor's 500 price target at 4,500. So it will grow, I'm sorry. And so a price target of 4,500 would be a normal recession, whatever that means, up from 4,000, which would be a systemic crisis or like a global financial crisis, something probably not seen since 2008, right? So they obviously expect that the tariff escalation between the U.S. and China is possible. Hopefully there will be an agreement to be made, but it is possible that this continues. And so after the 90-day pause, that created volatility. Interestingly, though, because this is their business, right? They know that the VIX index, for those of you that don't know, is it's the Chicago index. So essentially, it just measures volatility, right? So it's a popular measure for volatility in the market. And so every time over the next 12 months that there has been a high volatility in the VIX index, as measured by the VIX index since 1990, there's been a 9.3% return over that 12 period. So high volatility has historically been followed by higher than normal returns. which is so interestingly how the financial markets or the financial players, how they see this, right? So while the world, some people are affected. Let's not beat around the bush on that. Other people, or the financial players, see it as a moment to make money, right? You can hate it, you can love it, it doesn't matter. That's how they see it. This is what we're reading into this insight, right? Obviously, each case will be different, but nonetheless, they expect a high return because they found that on 12 occasions, as I mentioned, the S&P 500 has fallen about 20% from its peak in 1945. The index has delivered a positive return over the subsequent 12 months on 67% of the times that, and the mean return is 12.9%. So they expect about almost a 13% return after there's been like a dip, which is fascinating. Now, interestingly, they know that people are bearish. Sentiment means like you're not as positive about things, and so you tend to be more risk averse, so you don't want to take on risks, right? And so notably, bearish, according to them, right, bearish sentiment has historically served as a contrarian indicator, with the S&P 500 averaging a 27% return in the 12 months following the instances where sentiment readings exceeded 60%. And right now, at least at a 1-year high, 61.9% of those people that they surveyed were bearish on the market, right? That was a week before this was put out. On April 9th, that dropped to 58.9%. Still pretty high, right? If you were round up, it was 60%. And in those moments when people are averse to putting their money into the market, that's when most returns are going to be made in. So it's interesting. So one of the themes that you will find in the financial literature and in just investment advice in general, and again, this is not an investment advice emission, right? That's not what this is, but diversified investors. And so they explain to you where you should put your money, where they think that you should put your money. And it's interesting how they treat the commodities, right? So gold, they think about it just a yellow metal, which, essentially that's exactly what it is. But on April 10th, the ounce of gold was at $3,100, which is pretty up there, right? And their base case, and I'm about to explain in how they understand base cases, right? They think that there's going to be a target of $3,200 per ounce. So obviously, gold is a safe haven against you're hedging your bets against inflation, right? It stores value essentially. Interestingly, 10-year U.S. Treasury yields now stand at 4.42% compared to the year-end target of 4%. So it's much higher than their prediction. So of course, they have very smart people, right, that are very good at math and statistics and all that stuff, and look at historical trends, and they have not insider information, but they do have connections to governments to give them like a better insight as to what the governments are thinking, more or less looking at geopolitical trends. So they have very smart people, and it's hard to predict the future, of course. So they do miss the mark every now and then. Now, for their scenarios, right, base case is 50% probability. So basically it's like you throw a coin in the air. That's essentially what it is, right? So it might happen, it might not happen. Quite literally that black and white. So in their base case scenario, they believe that equities will remain volatile for the remainder of the year, basically, as trade deals and carve-outs are made. So after the Trump administration announced the tariffs on all countries, then countries started contacting them, and then I assume, right, that they're going to be able to work out these deals, however that happens, right? So in that process of readjustment of global trade, then there's going to be carve-outs, and then the tariffs will gradually start to come back down, right? At least that's what we think is going to happen, and again, anything can happen, right? They also expect that central bank rate cuts and progress towards a U.S. budget reconciliation bill. Now, this is in the U.S., right? They also anticipate that additional tariffs on sectors including pharmaceuticals and semiconductors are going to be announced at some point. Now, pharmaceuticals is a tricky one because I know that the European Union exports, as we've talked about it in a previous video, it's a lot towards the U.S., right? So that'll definitely have an impact on the European economy. And semiconductors, well, only specialized countries, right? And it's not all kinds of companies that export this. So this is going to be a more targeted one. And we'd actually have to see who actually exports semiconductors to the US, right? Overall, the UBS people expect a tariff rate with China to settle in the 10 to 15% range. They expect that Canada and Mexico will remain largely exempt from tariffs, which is an interesting take, right? When and how that will take place remains to be seen, but this is what they expect. And eventually, they expect that US-China tariffs will settle around 34%. So at this point, at the time of this video goes out, it's, I think, 125% tariffs from exports going from China to the US, and from the US to China, it's, I think, at 100%, 100 or 104%, something like that. But it's definitely 100%, north of 100% for sure. So they think that the US economy is going to slow down owing to weaker consumer confidence and potential disruptions related to trade. Tariffs on China, of course, I mean, that's to be expected. They expect the U.S. economy to grow by less than 1% on average in 2025. So they measure growth each quarter, right? So each quarter, then obviously the average growth that year. So 1% on average in 2025. But they expect unemployment to remain below 5%, which, I mean, you know, it's better if the economy grows, obviously, because that means more investment and more jobs. But it is interesting that in unemployment they expect it to remain below 5%, which is very good, right? Because, you know, some countries structurally, like, unemployment is 30%, and it's just how it is, right? You can check some European countries in that. Other global economies are likely to experience weaker growth in 2025, but they expect growth rates to remain positive. So, you know, not good, not bad. And interestingly, at the time of this is going out, if you check, China just posted its growth for the first quarter of 2025, and it was 5.4%. So imagine, just the difference in how the economies are working, right? They expect that policy stimulus in Europe and China will partially offset the negative effects on economic activity. It doesn't really go into detail on that, but I will definitely check that out, and we'll go into that in another video. They expect that the Federal Reserve, which is the American central bank, to cut rates by 75 to 100 basis points in 2025. So I guess by the end of it, that's what they expect. We'll revisit this and see how accurate this prediction was. And then the European Central Bank will cut rates at 25 basis points every meeting until mid-2025. Again, we'll check into that and we'll see where we stand, right? In their downside or hard landing scenario, because they have multiple scenarios that they model, right, and they think about. They think that equities would fall further as tariff negotiations generally do not succeed. I think that that's not going to be the case, at least with smaller countries. But with big countries like China, where it's not just economics anymore, this is clearly a geopolitical competition between both countries. Things might take a little longer for them to be settled down and things become clearer, right? So, and then U.S. pressure on U.S. domestic demand might trigger a U.S. recession. It's again tricky because who knows? There's so many factors that go into that. And it's just, I'm not obviously qualified to say anything about that. It's just reading the report, and we'll see what happens. On that one, we all have to wait, right? Whether it's going to be a U.S. recession, it's impossible to say at this point because we just don't know, to be quite honest, right? So in this scenario, tariff negotiations in the weeks ahead do not prove to be productive, and some countries start retaliating against the U.S. 10% baseline, right? They expect a downward pressure on U.S. domestic demand, which ironically, more of the stuff I do is like environmental, might actually be a good thing for the environment, right? So if you consume less, we're obviously consuming less resources, less energy, and that's actually a positive thing for the overall environment. So at least, you know, a silver lining and everything, right? Other things that caught my attention, at least in the first couple of pages or the first 10 pages of this report, is so the U.S. has obviously singled out China. As I said, there's 125% tariffs, and from there, it was 104% earlier in that day. So we all know what happened, right? That tariffs they went north one day, and this is, following an executive order, as I mentioned, the parcels from $800 and below went from 30% to 90%. This is effective May 2nd, so this will be next month because this will coming out in April, mid-April. And that's will affect about $40 to $45 billion of trade in largely e-commerce imports. So it is what it is. The pharma sector, 2.8%. Treasury yields as they were expecting, right? They were discussing. So what do they expect? Market volatility is going to remain elevated in the weeks ahead as investors rapidly shift tariff developments and consider partial applications for growth, inflation, and central bank policy and financial markets. Their base case, again, 50% probability, is that the tariffs are going to remain high in the near term. And again, it might or might not happen. Who knows? Honestly, nobody knows, right? It's you're flipping a coin in the air and seeing what comes up. So the U.S. administration is consistent with its de-escalate strategy toward much of the world. Well, we've seen that. Again, you might agree with it, don't agree with it. That's what's happening, right? In our best case scenario, they expect that tariff moderation rate cuts, like as I said, from S&P 500 to 5,800 by the end of the year. In the upside scenario, so like the positive, right? 20% probability, obviously it's less, that equity markets continue to rebound sharply and more prominent trade disputes and the avoidance of slowdown in growth and optimism about the impact of AI on earnings. And that one's a tricky one. We'll talk about AI, all of AI stuff in another playlist because it's just so revolutionary a technology, right? I do want to come to an end before we drag this on too long. They do, interestingly, think about transformational innovation opportunities. That's what they call it. And they look at four things, which I think is, pretty spot on, right? Artificial intelligence, because of all the potential for automation and all the insight that can give you. Longevity, which is interesting because most people, at least in the Western world, populations are getting older, and at some point people are going to start investing in healthcare, therapies, and mostly services, right, to try to extend their life, which is now biologically becoming a reality, or at least money's going into that, so who knows. And then power and resources, right, which power in this context means like energy and electricity, how you generate that, whether from renewables, nuclear, what have you. And then the resources that are needed to be able to get that power, right? So rare earths, lithium, all cobalt, all that stuff, right? So that's where they think that people can actually find refuge from the market volatility, right? So in the medium term, they believe that a sustained, they talked about their currencies, obviously. A sustained period of weakness for the US dollar is likely, which that's not necessarily a bad thing. Because if the US dollar is slightly weaker, then that means that more people can buy products from the US, which would mean that US exports go higher, and then like trade balances can come down, imbalances, I should say. And that would perhaps be the goal of the current US administration in terms of trade, right? And this is particularly true if the Fed cuts its interest rates quickly and more than expected. Given weakness in U.S. economic growth, right? But again, this is an independent body from the U.S. government, so that remains to be seen. And then the last thing I should say, and again, one last time, I want to stress this is not investment advice. So should I sell my equities now? And then the short answer is no. Basically, it's saying weather the storm, right? Because they predicted that multiple times after volatility, after a dip, there's a sharp increase again, right? So there's money to be made. The only thing that, of course, could affect this is that if the tit for tat continues, and then it's unfortunately a race to the bottom. Always a possibility. Hopefully it doesn't happen because it would be bad for the world economy, but it's always a possibility, right? And so the last thing I want to talk about is private credit, right? So what banks are willing to lend you. They expect a slowdown in lending activity and some debt servicing challenges as profit growth slows. So they expect that in the world economy, which is not a good thing for the rest of us, right? Because we're all employees somewhere. And it means that we're going into some pretty interesting times economically, whether you're a recent graduate from university or you're looking for a new job. or whatever sector of the economy you work in, that's not a good thing, right? Obviously in more challenged segments of the market, they favor that managers focus on sponsor-backed upper middle market and large cap deals in sectors insulated from economic and tariff pressures. At this point, I honestly could not tell you what that could be. Perhaps tourism, but I mean, how many people are actually involved in the tourism industry, directly or indirectly? You know, that could be one of the insulated sectors, but other than that, agriculture perhaps. But yeah, will remain to be seen. And obviously, we're going to keep an eye on this one, and just try to be as informed as possible, because I don't think even the experts fully understand what the consequences of what's going on trade-wise really is. So let's just keep looking for news, right? So until then, let's just keep the conversation going.